Ravi, let's start with the bigger picture. The IMF has lowered its forecast for emerging market growth to 4% this year from 4.6% last year. What are the biggest factors for this?
Well, I think it's the slowdown in countries like China, slowdown in Europe, which has been going on for a while now, and the drop in the commodity prices, particularly from the demand shrinking in China, has brought about a slowdown in many of the other emerging markets. As you know, China is an important market for many countries around the world, particularly in Asia, and the slowdown in China has just added to all of the problems in the emerging markets.
So emerging markets definitely taking a knock from the commodity decline. What about the business owners there? Are they now having a tougher time accessing capital?
You know, I think the answer to that depends on which countries you're talking about. I think in countries like India and China, money is still reasonably available and not terribly expensive. Nominal interest rates are still in the single digits. But then you can go to the other extreme, go to a country like Brazil. The interest rates have gone up, doubled in the last year or so, and it's about 15% in Brazil. In Russia, in Turkey, in the Ukraine, in these places, capital has become very expensive. And at the same time, the stock markets have fallen, and therefore, raising money through issuing equity is not a very attractive proposition. Now, there was another option that was popular a few years ago, and that was to borrow abroad where the interest rates were very low. But that option has disappeared because foreign investors are not willing to buy the bonds of companies from the emerging markets, particularly those like Brazil and the others that I mentioned.
Now, with regards to accessing capital, the IMF is warning against the U.S. Central Bank, the Fed, raising interest rates. How would that impact businesses in emerging markets?
Well, I think one of the reasons for the rising interest rates in the emerging markets is the anticipation of rising interest rates in the U.S. And in fact, in the emerging markets, the increases have been much higher because of the exodus of foreign investors. This is the problem for many of the emerging markets, and one of the reasons for the volatility in the emerging markets is that foreign investors sometimes get very optimistic and go in hordes into these countries. When they decide to pull back, even if they pull back only slightly, the impact on the emerging markets and the cost of capital in these countries is quite high. And that's the reason that the interest rates are being driven up in many of these emerging markets.
All right, other than the access to capital and perhaps the decline in commodities, what are some of the other challenges that business owners in emerging markets face that business owners and entrepreneurs in the US or Europe and other developed markets don't?
I often think that it's much harder in many ways to be a CEO of a company in an emerging market than it is to be a CEO of a company in the US. We already touched on the volatility. This is one of the factors that managers in these emerging markets always have to deal with. You know, there are not many developed countries in which the currency could fall by 50% in the course of a few months. But that's exactly what's happened in Russia and Brazil and so on. So the volatility is a huge challenge. But the other thing is that the business environment is reliably unreliable. That means on a daily basis, you're dealing with unreliable suppliers, you're dealing with power that may not be available as promised, and so on and so forth. Suppliers you cannot depend on, employees you cannot fully depend on, governments that can be arbitrary and capricious and unpredictable. So all of this creates enormous managerial challenges that CEOs of companies in the emerging markets have to deal with. You don't have them to the same extent in the developed countries.
Are there any opportunities, though, that are specific to emerging markets and entrepreneurs, perhaps playing on that volatility or lack of reliability, or perhaps that the market is still open for newcomers?
You're absolutely right. I mean, there's always a silver lining to any kind of cloud. In this case, I think what these companies have learned to do and the managers in these countries have learned to do is to build the capacity to be resilient. Now, this is a buzzword in the developed countries these days. Companies are worried about what happens if there's a shock to our supply chain system. How do we respond? How do we build resilience into the organization? Well, these companies in the emerging markets have learned how to be resilient. And I think that's a capability that's of real value, not only in their own home countries, but even when they try to expand into other emerging markets. So they can take some of these capabilities and move them And they find that to be an advantage when they go into a new market that is also an emerging economy.
All right, absolutely. Resiliency, very important trait all around. Thank you so much, Ravi Ramamurti, Professor and Director of the Center for Emerging Markets at Northeastern University.